They spent $1 billion on bananas and lost it all in 18 months. It wasn't just bananas, of course. It was every conceivable grocery item, from artisanal cheeses to toilet paper, promised to your door with unprecedented speed and precision. Webvan wasn't merely an online grocer. It was an audacious vision of the future, a logistical ballet choreographed across a continent, backed by venture capital eager to pour money into anything with a com attached. The year was 1999, the height of the dot-com boom. Money flowed like champagne at a Silicon Valley launch party, and skepticism was a rare, unfashionable trait. Webvan arrived not with a whimper, but with a roar, a colossal bet that the internet would fundamentally transform something as mundane, yet essential, as grocery shopping. Their premise was simple. Why drive to the supermarket, push a trolley, and wait in line, when you could click a few buttons and have everything delivered to your doorstep within a precise 30-minute window? On paper, it sounded like a no-brainer, a convenience so compelling it would surely revolutionize an entire industry. But the devil, as always, was in the details, and Webvan's details were less devilish and more apocalyptic. Their strategy wasn't just to build an online storefront. It was to construct an entirely new infrastructure, a vast, complex network of automated warehouses, custom software, and a fleet of specially designed delivery vans. Louis Borders, the founder, wasn't a grocery veteran. He was a co-founder of Borders Books, a retail giant in its own right, but a very different beast. His ambition for Webvan was colossal, to build 26 state-of-the-art distribution centers across the U.S., each costing around $30–35 million. These weren't just big warehouses, they were technological marvels, featuring miles of conveyor belts, robotic pickers, and sophisticated climate control zones. The idea was to achieve unparalleled efficiency, picking orders with surgical precision and speed. The investment was staggering. By late 1999, Webvan had raised over $375 million from private investors, including Sequoia Capital and SoftBank. In November of that year, they went public, raising another $375 million. The IPO was a sensation, valuing the company at $4.8 billion on its first day of trading. The hype was palpable, almost intoxicating. The problem, however, was that building this infrastructure took time and immense capital. While Webvan was constructing its futuristic logistics network, it was also trying to operate a complex, low-margin business. Groceries, unlike books or software, have razor-thin profit margins, often just 1–3%. Each order required careful handling, refrigeration, and precise delivery. A single missed delivery window, a bruised avocado, or a melted ice cream cone could ruin a customer's experience and erode trust. The cost of the last mile getting the order from the distribution center to the customer's door proved astronomical. Webvan's burn rate was legendary. They were spending money faster than most companies could even dream of earning it. At its peak, the company was reportedly burning through $1 million a day. $1 million every single day, just to keep the lights on and the vans moving. They expanded aggressively, too quickly, into new markets like Atlanta, Chicago, and Los Angeles, before even perfecting their model in their initial San Francisco Bay Area stronghold. Each expansion meant more multi-million-dollar warehouses, more hiring, and more operational complexity. The promise of those 30-minute delivery windows often fell short. Customers reported late deliveries, incomplete orders, and a general sense that the sophisticated system wasn't quite as seamless as advertised. Word of mouth, which had initially been positive due to the novelty, began to sour. Then came the dot-com bust of early 2000. The easy money vanished. Investors suddenly wanted to see profits, not just projections and potential. Companies that had once been darlings of Wall Street were suddenly scrutinized with a harsh, unforgiving lens. Webvan, with its massive losses, stood exposed. The company's share price plummeted from its IPO high of $34 to mere pennies. Employees, many of whom had joined with stock options, watched their fortunes evaporate. The dream of a new grocery paradigm was rapidly turning into a very expensive nightmare. In June 2001, barely 18 months after its IPO, Webvan announced it was ceasing operations and filing for bankruptcy. Over 2,000 employees lost their jobs. The company that had been valued at $4.8 billion was liquidated for a fraction of that, its assets sold off for pennies on the dollar. What went wrong? Many things. Overcapitalization, certainly, expanding too quickly without proof of concept. But fundamentally, Webvan failed to understand the economics of grocery. It's a volume business where efficiency at every single step is paramount. They spent billions building infrastructure for a demand that simply wasn't there at the scale required to justify the investment. Customers, it turned out, weren't quite ready to pay a premium for home delivery or didn't value the convenience enough to cover Webvan's exorbitant operating costs. The technology itself, while impressive, was also a major drain. The automated warehouses were cutting-edge, but incredibly expensive to build and maintain. And the bespoke software, designed to manage every aspect of the complex logistics, was prone to glitches and required constant, costly updates. Webvan's story is a classic cautionary tale of the dot-com era. A brilliant idea, backed by vast sums of money, undone by a catastrophic misunderstanding of fundamental business economics, and a dizzying pace of expansion fueled by hype. It demonstrated that even with unlimited capital, you couldn't simply tech your way out of a business model that didn't work. The core economics of grocery delivery, even 2 decades later, remain incredibly challenging, as many modern players like Instacart and Amazon Fresh can attest. Yet the ghost of Webvan lingers. Elements of its vision, automated warehouses, precise delivery windows, online grocery ordering, have all become commonplace. The company was perhaps just too far ahead of its time, or rather, too arrogant in its execution. It serves as a stark reminder that innovation, while exciting, must always be grounded in reality. The dark side of ambition can lead to spectacular collapses, especially when billions are at stake and the market's appetite for risk suddenly evaporates. Webvan's epic fail wasn't just a loss for investors. It was a brutal lesson for Silicon Valley, a testament to the perils of unchecked optimism and the unforgiving nature of the market. Next, we unravel the intricate web of deception behind Enron's catastrophic downfall.